In today's video, I'm going to show you a different use of the Fibonacci sequence in trading. You can use this technique in stocks, commodities, futures, forex, and cryptocurrencies, and in any time frame you wish to trade as well. In other words, the technique works in the exact same way in all markets and in all time frames. I will explain the technique with a few illustrations first, and then I will move on to real examples in different markets. I will also show more variations of this technique, which is quite simple, but it can also be very effective. If you're new here, please consider leaving your like and subscribing to the channel right now, as this helps support the ongoing creation of free videos like this one. Let's now begin talking about the technique in question by making a very brief review of the Fibonacci sequence. The Fibonacci sequence is very simple to understand. It begins with the numbers 0 and 1. To know the next number in the sequence, all you need to do is to sum the last two numbers. For example, if we want to know the third number in the sequence, we sum the first and second numbers. In this case, the third number is going to be 0 plus 1, which equals 1. If we want to know the fourth number in the sequence, we sum the second and third numbers. In this case, the fourth number will be 1 plus 1, which equals 2. By repeating this process time after time, we'll get the Fibonacci sequence. That's all there is to it. Most traders use the Fibonacci retracement and expansion tools, which are based on the ratios obtained when we divide two numbers in the Fibonacci sequence. However, that's not what I'm going to talk about in this video. Today I will show you a different way of using the Fibonacci sequence in order to predict major price reversals. The technique I want to show you is called Fibonacci Counting. This technique is very simple, but it can be very powerful as well. It states that the number of candlesticks between significant reversals in price are usually close to a number in the Fibonacci sequence. This is better understood with a visual illustration. Take a look at this image. This is a hypothetical piece of price action. We can see a few reversal points in there. If we label each major reversal as 0 and start to count the number of candles between reversals, we'll see that reversals will occur when the candlestick count reaches a Fibonacci number. The numbers that are in the Fibonacci sequence are highlighted in orange. For example, the first movement to the upside is composed of 13 candles. 13 is a number in the Fibonacci sequence, and it marks the absolute high in this case. The second movement goes to the downside, and it has 8 candles in it. 8 is also a number in the Fibonacci sequence. This is just a hypothetical example to show you what this technique is all about, but it's clear that real charts don't work as perfectly as this. Reversals will sometimes happen near Fibonacci numbers, not exactly at the numbers how it is shown in the image. There are mainly two ways of using the Fibonacci counting technique: from low to high or from high to low, which is what you saw in the last illustration, but you can also count candles from high to high or from low to low. Let's move on to real price charts now in order to see how this technique works. We begin with a very simple example of the daily chart of the euro-dollar. In this chart, you can see that I marked two price movements with black lines and three major reversals labeled as A, B, and C. If we apply the Fibonacci counting technique from A to B, we'll see that there are 5 candles between A and B. Recall that 5 is a number in the Fibonacci sequence. If we apply the Fibonacci counting technique from B to C, we'll see that there are 21 candles between B and C. 21 is also a number in the Fibonacci sequence. This is clearly an example where this technique worked perfectly. The reversals happen exactly at one of the numbers in the Fibonacci sequence. Some of you might be wondering in which of the numbers in the Fibonacci sequence you should expect a reversal. The secret here is to use this technique as a confirmation to other techniques. By itself, the Fibonacci counting technique will be very tricky to use. Let's now observe a few examples of that. Here you can see the 1-hour chart of Apple. Before we talk about the Fibonacci counting technique, we must pay attention to other things that are happening in this market. I once again marked two price movements and labeled the reversals from A to C. At high B, you can see that I drew a supply zone. If you're not aware of how supply and demand zones work, check the Ultimate Beginner's Guide to Supply and Demand Trading in the video card. The reason I marked the supply zone is that low C surpassed the low A, meaning that the sellers in B were powerful enough to drive this market lower than before. The ideal scenario here is waiting for price to come back to the supply zone, and depending on how price behaves in there, maybe take a short trade opportunity counting on the sellers we already identified. Before moving on, since the main theme of this video is the Fibonacci counting technique, let's perform a quick analysis on the price action we have so far. In this chart, you can see that from A to B, we have 15 candles. The closest Fibonacci number is 13. That's what I meant when I said that reversals will not always happen exactly at the Fibonacci numbers. Even though the Fibonacci counting technique is not exactly accurate in this case, take a look at how close to high B the candle 13 is. In this next chart, you can see that there were 7 candles from high B to low C, just 1 candle less than the Fibonacci number 8. Even though the technique was not exactly right, it was pretty close. Let's now advance price to see the further developments of this market. In this chart, you can see how price comes back to the supply zone. The interesting thing here is that price enters the supply zone exactly 21 candles after the low C. 21 is a Fibonacci number. Notice also how price goes a little higher to test the upper limits of the supply zone, and then a dynamic frequency breakout happens, inducing a reversal to the downside. If you want to learn more about dynamic frequency breakouts, check my premium course in the video description. Let's now check what happened with price. In this chart, you can see how the intersection between the Fibonacci counting technique and the supply zone induced the market into a large reversal to the downside. This is a much better use of the Fibonacci counting technique. Of course, this is just one of the hundreds of possible combinations of techniques. Before we begin the last example, let me introduce another idea. So far, we have used the simple Fibonacci counting technique, but there are slightly more nuanced ways of using it, since reversals will not always fall exactly in Fibonacci numbers. That leads us to the idea of using Fibonacci counting with margins of error. So instead of looking at a specific candle for price to reverse, we look for a specific area or range. Let me show you what I mean with simple illustrations. For example, let's say we are expecting price to reverse around the 13th candle, but we are not sure if that's where price is going to actually reverse. We can add and subtract 10% of 13 in order to create a time range where price might reverse. 10% of 13 is 1.3, so let's round it down to 1. The left part of the range is 13 minus 1, which equals 12, and the right part of the range is 13 plus 1, which equals 14. In other words, by using a 10% margin, the reversal is expected to occur between the 12th and the 14th candle. You don't have to stick to the 10% value for the margin of error. This is just a baseline value. A larger margin of error would produce a larger range. Notice also that reversals that are expected in bigger Fibonacci numbers will inevitably produce larger ranges. For example, if a reversal is expected to occur in the 89th candle, the range using a 10% margin of error will be 9 candles, since 89 times 10% equals 8.9, so we round it up to 9. In other words, the reversal has a space of 18 candles to occur in that case. Okay, so enough with the theory. Now let's move on to a real chart and observe how that works. And I will show you yet another technique we can build based on this idea of time ranges from Fibonacci counts. In this chart, we have the 15-minute Bitcoin versus the US dollar. I have marked 3 price movements and labeled the major highs and lows from A to D. I also marked an inward frequency line and the absolute high line from B. This is a place where sellers could still hang around since low C is lower than low A. The point I want you to pay attention to is D. At this point, price comes back to the supply zone that was drawn from point B. Interestingly enough, if we perform a Fibonacci count from low A, we'll see that the Fibonacci number 55 will fall in the middle vertical line. In this chart, I also added the 10% margin of error to both sides of the 55th candle. In other words, a reversal can be expected between the 50th and the 60th candle, as it is shown by the blue area. Beyond using the margin of error in alignment with the Fibonacci counting technique, we can also use the intersection of different Fibonacci time ranges that come out of the Fibonacci counting technique. I will erase the vertical lines and keep the blue area highlighted to remind us that this is the time range of probable reversal if we perform the Fib count from low A. In this next chart, if we perform a Fibonacci count from the low C up until the current price action in D, we'll see that there are precisely 8 candles. In other words, the current candle, which is a fractal candle by the way, is sitting exactly at a Fibonacci number if we do the count from low C. The outer lines represent the 10% margin of error from 8, meaning that the area of probable reversal, which is narrow now since we are talking about a smaller Fibonacci number, happens between the 7th and the 9th candle from low C. The point here is that we have the convergence of 2 different time ranges of probable reversal coming from the Fibonacci counting technique that uses margins of error instead of precise candle counts. Let's see what price does next. Notice how price began to go down exactly from the intersection between the 2 time ranges, which is highlighted by the red rectangular area. Notice that I'm giving you different examples of the same technique in different markets and in different time frames, so you can see how all price charts are exactly the same. Bringing the analysis forward a little bit, in this other chart, you can see a bullish reversal divergence happening in the relative strength index. This is a sign that price action might reverse to the upside. However, this is merely a sign. If you want to trade in here, you will have to realize that there are a lot of things going on. I will show a few of them respecting the overall theme of this video. We can find the convergence of time ranges from Fibonacci counts in this area as well, just like we found in high D. Pay close attention to this other chart because it summarizes the elements we have been talking about so far in a different scenario. The first vertical line represents a Fib count from low C at 34 candles, and the blue area is the 10% margin of error regarding this count. The second vertical line is a Fib count from low A at 89 candles, and the red area represents the 10% margin of error for that count specifically. The purple area is the intersection between the 2 time ranges, which is where price action is located at the moment. A small but significant detail here is the inside candle at the current moment, showing a temporary stop in price. If you don't know how candlestick patterns work, make sure to watch the Ultimate Beginner's Guide to Candlestick Patterns in the YouTube card. From this point onward, I would just leave the purple area highlighted to clean up the chart and show other elements of this market. Now I want to look at this chart from a different perspective using what I have talked about in my latest video about the Elliott wave theory. One of the best aspects of this theory is the fundamental 5-3 pattern. I'm not a fan of the overly specific rules of Elliott wave theory for a variety of reasons that go outside the scope of this video, but the fundamental idea can be useful sometimes. The point here is that we can find a 5-wave pattern in the market movement that goes from D to the possible major low E, as you can see in this chart. Notice that I'm not worried about wave degrees or anything like that. I'm just focused on this market movement, which might upset Elliott wave traders a little bit. If you're not familiar with the Elliott wave theory, make sure you watch the Ultimate Beginner's Guide to the Elliott wave theory in the YouTube card. Without getting too much into the specifics here, I just want to show you a complementary Fibonacci tool in the time domain. If we place a Fibonacci time zone tool from the beginning of wave 1 until the end of wave 1, you'll notice that the current candle falls exactly in the 461.8% ratio. That would be a third convergence if we count the 2 we already have so far with the Fibonacci counting ranges. As a final step, even though it seems that we are about to see a reversal to the upside, it also seems that price action could very well continue going to the downside without any problem. Finding a horizontal level to support the long trade idea can help with that, and it turns out that we have a pretty good one. If we look at the movement from low C to high D, we'll notice that it begins with low volatility candles, and then it explodes to the upside in a wide range candle. This marks a point of decision from buyers, meaning that was a place where buyers really took control. If we mark that level with a simple horizontal line, we'll see that the current price action is respecting it as a support. Now it looks a lot more comfortable to imagine a reversal to the upside. A good place to put a stop loss order here would be below low C, assuming you are using a target that is at least 3 times as large as the stop loss. Let's see the outcome of this idea. In this chart, you can see how price reversed to the upside from the intersection of techniques we found. High-quality trading is all about finding the intersection of non-lagging tools, but there are tens, if not hundreds, of tools you need to understand in order to become effective. The challenge, of course, is being able to spot the intersection of techniques in real time. That's partly what makes a good trader. This is it for this video. I hope you are able to learn something new and useful for your arsenal of trading techniques. If you want to learn how to trade with many other techniques like this one, and how to read the market at this level of detail, make sure you check out my premium courses in the video description. You can also send me an email if you want to understand more about which course you should choose. If you like the material I produce here in this channel, please help support it by clicking the like button, subscribing to the channel, activating the notifications button so you don't miss future uploads, and leaving your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.